Meta shares are up over 40% so far this year as investors double down on the AI trade. And our next guest says that there's more room to run, raising his price target from $475 to $540, driven by ad momentum. Justin Patterson, KeyBanc Managing Director, joins us now. Justin, great to speak with you here. Okay, so take us into the thesis here and what's shifted in the ad landscape and in terms of what you're seeing for the load demand that would benefit Meta versus some of the other competitors?
Yeah, definitely. And thanks for having me. So when you look at just pricing data, so data just on what Meta advertising prices are going for right now, they're actually accelerating sequentially. So you saw about an 8-point improvement from Q1 to Q2 quarter to date. And that's actually against a tougher comp. So what that means is that demand for Meta's advertisements remains very high. It's an auction. You're seeing more advertisers bid higher rates to reach Meta's customers. And that just really shows you that the returns from this AI advertising cycle are still very strong. So when we look to the second half of the year, we don't think the deceleration in growth against some tough comps will be as severe as investors think. And we think there's still potential for mid-teens growth in 2025. When you roll that together, that speaks to earnings upside, free cash flow upside, even against all this CapEx investment.
Let's talk about that CapEx investment, because you mentioned in your case here that Meta is investing aggressively in AI and that could improve the core business. We talk a lot about all of these companies investing in AI. What is it about what Meta is doing specifically under the hood that you feel is a bullish signal for the company?
Yeah, I think it's a couple of things right now. First, you're already seeing the benefits in terms of engagement. So if you go back to the Q1 call, Meta cited several stats in terms of just how this recommendation engine powered by AI is driving more video consumption, more time spent on Meta sites. And that just means there's a lot more ad impressions to serve. The second piece that's really happening is under the hood on the ad tech side. So as you really refine what type of ads people are seeing, provide them more relevant ads, that really boosts the return for the advertiser and encourages them to spend a little bit more on ads, which is what we're seeing in that pricing trend right now. So we really think there's a just powerful flywheel going on at Meta. As these capital investments get some returns, you're seeing better revenue growth come in, and that just fuels a little more investment in terms of data centers.
And just, on this, while we've got you, there's the larger concern about what will happen if TikTok does get banned, if there is no suitor that steps in and purchases and allows them to remain operable here in the US. What does that mean for Meta? What's that mean for the advertising windfall that they may start to get from that too?
Yeah, it's a great question. So if you just consider TikTok, you're getting roughly 90 minutes of time spent per day on the TikTok app that has to get reallocated somewhere. So when we look at it, we generally think that Meta, Alphabet's YouTube, and Snap are the biggest winners from that. Just because they all have short form video apps, and that time spent will go back to the Instagrams, the Facebook Reels, the YouTube Shorts, so on and so forth.